So the real problem is that it's not one tax. Most people think that they pay income tax and that's it. But the reality is far more complex. So it's income tax, it's national insurance, investment income, which creates dividend tax. If somebody's a company owner, then there's dividend tax there as well. There's capital gains tax. And you might think, well, we're talking about income. Where does capital gains tax come in? But when things are structured correctly in investments, there are capital gains tax allowances that can be used. Loss of personal allowances. So, both in terms of loss of personal allowances, things like loss of child benefit for higher earners as well. Not using allowances is another one that we do see that people underestimate the impact of utilising things like ISA allowances on an annual basis and how that can impact income later in life. So if you're building up an ISA portfolio on an annual basis, the ISA allowance is 20,000 a year. That changes in April 27 for cash ISAs, where the ISA allowance will be reduced to 12,000. And I'll touch on that again in a moment. But effectively, the ISA allowance is there to build up ISAs in a tax efficient way with the aim to then switch on an income later in life in a very tax efficient manner. We often see clients not looking at ISA allowances until later in life and then haven't really got that time frame or not got as much of that time frame to build it up in a tax efficient way. So don't underestimate using some of your allowances, even if you can't use it all, using some of your allowance on an annual basis with the magic that is compound returns in a tax efficient way will really have a knock-on effect then later in life, particularly if you're then relying upon investment income in retirement, for example. And then obviously there's things to consider as you build that up in terms of things like inheritance tax. So when we think about taxes, there's multiple layers of things that actually impact your tax position overall. Whilst you're building that up with income, then it is on an annual basis, on a monthly basis. So we're looking at that. But then you've also got that one eye on what that capital looks like in the future. Is it structured in the correct way? Not having all your eggs in one basket. We've seen that recently with pensions, that people have built up pensions over the years, which is still a brilliant thing to do on an annual basis. But what you've also got to have an eye on is that if you've got all your eggs in one basket, whether that's pensions, whether it's property, whatever it is, that the rules could change in the future, and therefore making sure that you are utilising different allowances, different tax wrappers will put you in a good position from a tax planning perspective in the future. So the challenge isn't just one tax, it's how they actually all interact both now and in the future. One of the things that I just mentioned was ISA allowances, and it's been announced in the budget that from April next year, the cash ISA allowance is reducing. Some of the feedback on budget day when, the news outlets were out there videoing people was, I'm over 65, therefore I'm keeping my cash ISA allowance at 20,000 and thinking that that's a positive thing. And I understand that perspective. But what you've got to think about is that the reason the cash ISA allowance is being reduced and the stocks and shares ISA allowance is being maintained is that as a nation, we're not investing enough. We've been relying too much on cash. For circa 15 years after the credit crunch, we had very, very low cash rates of returns. At the same time, we had very consistent returns in stocks and shares. And therefore, the loss of that investment growth during that time frame has become a problem for people's assets and liquid assets, particularly later in life into retirement. The difference is quite staggering if you compare investment returns during that time frame with cash-based returns. And that is why they are reducing the cash ISA allowance for those under 65.